Good morning, everybody. Welcome to today's Morning Coffee with Mike. We're talking about how to get started trading, the beginner's guide. We're going to go through all the different questions that I wish that I had asked when I was first starting out. I'm going to share with you the answers that I would have given to my younger self for those questions. Now, there's a lot of questions that people ask when they're first starting out. I want to hear the questions that you guys have as we're going along, so feel free to post them into the chat. Another thing before we get started, too, I want to see what notes and what takeaways you guys have. So, as we're going through today's live stream, I want you to take notes, post them on social media, wherever you happen to be watching. Tag me in the notes, and if they're strong, good comments that are worthy of being shared, I will share them with my audience. So let's talk about some of the questions that I wish that I had asked when I was first starting out. The first question that I wish that I had asked when I was first starting out was, how much money do you really need to start trading? Well, when I first started trading, I just took all the money that I had and went down to my local bank, didn't even know where to uh, start investing. And I started with my full amount. At the time, it was $5,000. To me, at that time, $5,000 was a lot of money. It's not the amount that really matters. That's what the Mike of today would say. It's not the amount that matters. What matters is this. What matters is that you start with an amount that is not going to kill you, that's not going to really truly hurt you if you were to lose it all. Go into it with the expectation that there's a strong possibility that you could lose it all, especially when you're starting out. You're still learning all the skills that are necessary for trading. However, you should start with an amount that will sting if you lose it. And this is where it gets where you need to customize the amount for yourself. So, for example, let's say that you're somebody that's starting out and you're very fortunate. You have $10 million to invest. Let's say that you inherited this from somewhere. You have 10 million to invest. How should you get started with that 10 million? Should you put the whole thing in? Well, no. Right? If you're just learning, you should not start out with the full amount, whatever it is. Maybe for that person, they start out with 100 grand. Maybe to that person, 100 grand is not that much, right? It's 100 grand out of 10 million, not that much at all. For another person, they might aspire to get to six figures. And if they had 5,000 and that's all that you have to start out with, then maybe you don't want to start out with all that. Start out with an amount that won't kill you completely if you lost it all, but an amount that will sting a little bit if you were to lose it, an amount that you do care about. That way, when you are putting on trades, you're not doing it in a willy-nilly fashion. You actually care, yeah, and because you care, you're going to go through your entire planning process. Now that brings us to the next question for what a beginner should be asking, and what I would have asked when I was first starting out. What I wish I would have asked when I first started out, and that's this: how long does it take to become successful? Fairly common question. I get this question all the time. I didn't ask that, unfortunately. I just thought that you take money, you put it in, and more money magically pops out the other side. Learned the hard way that that's not the case. So, how long does it take to become successful? Right in the question itself, there's there's a few different problems. The problem with asking how long does it take to become successful, or we need to work out a couple of things, because if we have length and we add in ambiguity, the only thing that we're going to come out with is pain. Well, what do I mean by that? If we don't have a clear definition of what success actually means, then it could just be wandering around in the desert, hoping to get out, and we don't know which way is east north, south, or west. So we need a clear definition of what success means. Few questions that we might think of, well, what does it take to be successful? What do you think that it takes to be successful? Type into the chat, let me know. I'm curious to hear. Few things that tend to come up often are a certain dollar amount. Once I hit a certain dollar amount, then I'll be successful. Maybe if I beat a certain benchmark like the S&P 500 or the Nasdaq over the course of a year, maybe then I'll be successful. Maybe consistency for a certain period of time, then I'll be successful. How about this? A point where you have a money machine and it's easy. That was my definition of success way back then. And there's a big fallacy in there too. And I'll tell you what that fallacy is. The fallacy is that there's a point when it becomes easy. It does not become easy. There's always going to be challenge with trading. We're always going to need to put in work for trading. If you want to have returns that will consistently beat the major indexes, S&P 500, Nasdaq, or to at least give yourself the opportunity, there's always going to be work involved. It's never going to be just kick up your feet, relax, and you don't have to look at it at all. That's not how it works. And if it did work that way, then there would be loads of people, everybody would be successful. You wouldn't need to be on here listening to this because you would already have reached that level of success yourself. I would have already reached that level of success, and there wouldn't be anything for us to even talk about. So there's never a point when it's easy. There's always going to be work that needs to be done. So, what are some ways to define success? Well, one way might be to become the next X. Right? Well, whatever X is, whatever fill in the blank is. I want to become the next William O'Neill. That was one of my goals back then. I wanted to become the next Mark Minervini. That's still a goal to have that level of consistent performance year over year over year. He's been doing this for nearly 40 years. I'm on year 25, have about 15 years under my belt of doing this successfully, right? So it's almost an impossible goal because he's older than me. I can't catch him. So it's good to have goals that stretch us in that way. But I think an important thing when we do come up with what our measure of success is going to be is to come up with the different types of metrics that will help keep us on track towards said goal. Now, there's many that we can talk about in there, far more that, that it could be its own live stream. It could be its own course, frankly, and it's even a large section in my book, The Trading Mind Wheel. But I'll give you a few metrics that everyone can start with. First metric is how closely and how often did you adhere to your trading plan? So you should have a trading plan. How often do you adhere to your trading plan? Do you adhere to it to the letter? Do you deviate a little bit? How often are you adhering to your plans? Track that. Another thing is what is your average gain on your winners? What is your average loss on your losers? How many of those do you have each month? Track it monthly. And what is your win rate? So even in there, right, you'll start to track your win rate by default. Those are good metrics to begin tracking, and that will help you figure out, well, how long will it take me to be successful? If you are approaching trading in this way, this more of a systematic approach, then it should take you several years to become successful. Just like if you were to go to school to become a doctor, a lawyer, an engineer, if you were to learn a trade like being an electrician, being a plumber, it's going to take you a couple of years to learn the initial craft and then several more years to actually get good at the craft. Think of trading in the same way. Give yourself time to learn what you need to learn and then put it into practice and then get great at it. If you don't, then you're going to be the average trader. And unfortunately, the average trader is a losing trader if our definition of trader is anyone who opens up an account. If you're going to be somebody that is consistently profitable, expect it to take at least a couple of years of dedicated effort and in uh, learning the skills. And that brings me to the next question. The next question that I would ask myself as a beginner is, what skills do you need to become successful? Right? So we figured out what success looks like. Well, what skills do I even need to become successful? Well, there are 8 skills in total that you will need to learn, master to become successful at trading. We've already touched on several of them. This whole conversation involves mindset. This whole conversation has involved philosophy. Philosophy, mindset, I see them as interlinked. I also see psychology as being linked in there as well. Mindset involves our beliefs. Mindset involves our belief systems. So think of mindset, think of beliefs as a garden. You have a mental garden. If you don't go and take a look at your garden, there might be anything growing there, right? Maybe you have some plants, maybe you have some things that you want to keep. You probably have a lot of weeds. You probably have things that are overgrown, things that maybe you forgot about that were even there. You need to go and assess what's in your mental garden. Then you're going to need to remove a lot of stuff, things that are no longer serving you, remove some weeds. Maybe there's a few things there that are still good. Great, you're going to do that. Then you're going to want to install the good plants that you want. So, what's that for us? Those are going to be beliefs that are leading us to the goals that we've laid out for ourselves. Are they leading us further from or closer to our goals? Do we want to hang on to these beliefs? Yes or no? Our beliefs are kind of like, think of them as software, software that's going to lead us to that's going to control our actions. So it's very important for us to weed our mental garden. Mindset is linked to everything. Next up is journaling. We touched on journaling a bit too. How are you going to track your metrics? How are you going to become successful if you don't know which way you're going? The way that you're going to know which way you're going is by journaling. So you need to develop your skill set in journaling, how to journal effectively. Next up is analysis. What is it that you're going to analyze? I think that there's three basic things that we need to analyze. We need to analyze the thing itself, right? We need to analyze the thing itself. We need to know if it's a good trade or not. We need to analyze the environment that it's in. And we also need to analyze ourselves too. 3 things that we want to analyze. Next up, risk. We need to figure out how much we're going to risk per trade and in our portfolios as well. All different kinds of risk. We need to understand trade management. How will we manage the trade throughout the entire life cycle of the trade, from when we first take the trade to when it's starting to move in our favor to when we're ultimately going to sell this thing? How are we going to manage the trade throughout the life of the trade? Portfolio management is another skill. It's one thing to take one trade, it's another thing to have on 3, 4, 5 trades at once. Maybe you're somebody that wants to take on 10 trades at once. Maybe you're managing a large portfolio. Portfolio management in itself is a skill. How we're managing individual trades, trade management, how we're managing many trades, portfolio management. Post analysis, very important skill, and we must journal to even get to the post analysis, because if we don't journal, what are we going to post analyze? It makes the whole process extremely difficult, if not impossible. And finally, testing. Testing is where we go through our post analysis, or perhaps you have a theory that you want to test out, and you can learn how to back test. You can learn how to forward test, which is testing in real time, and you can learn how to factor model, which is the one that I actually recommend starting with if you're going to do testing by factor modeling, which is what I did. It's what O'Neill did. It's what Minervini did. It's what many of the success stories of the past have done. And simply speaking, what uh, factor modeling is, it's taking a look at what has worked and dissecting why. Those are the main questions that I would ask myself, or that I believe that a beginner should ask, and those are the answers that I would have given myself if I could go back in time and speak to my younger self. Now let's take some questions. I see a couple of questions coming in over here on YouTube from Naveed. Naveed is asking, what stage do you typically buy? And does the weekly chart also need to have pullback to a certain moving average or level? I will typically buy when a stock is setting up in an actionable pattern that I've clearly defined, right? So kind of goes back to what we were talking about before. We want clear definitions. What's going to be a successful setup? A successful setup is going to have a clear definition. I'll know how many weeks it's going to be. I'm going to know the proper depth of this pattern. I'm going to know how this pattern should look, the general look and feel of it. And I want to see how this pattern is setting up across time frames. So this starts to speak to part two of your question. Will it be pulling back to other moving averages? Yes. Will it have other layers of confluence around it? Absolutely. The more layers of confluence that we have in our setups, the more likely they are to work. And equally as important, when the setups don't work, it makes it very easy for us to cut them loose. I like to show you an example of a trade that I was thinking about, but later canceled. And here it is. This trade in Delo. I was taking a look at this trade yesterday, and this is how I saw it yesterday. I saw this big run up after earnings, gapped up about 30, almost 32%. Then it formed this short cup with handle. It has the essence of a cup with handle, but it's not quite a cup with handle. A cup with handle, a true cup with handle, should be at least 7 weeks long. This, I think, is only about 4 weeks long. This was from August 16th. Yeah, it's only about 3 weeks long, truly. So it's more of a pullback buy. But I did see it forming this base here. It launched off of here, and then it formed this little handle area in there. When it was forming that, my idea was, okay, I'll get in above this day's high here at around 2190, and I will have my stop loss around here at around 2110, 2115, somewhere like that. And at the time, I was going to risk about 3%, about 3%, give or take. And then on this day here, it actually broke below support first. And I just had a conversation with our members about why I would cancel an order like this just because it broke support. It ended up reversing on the day. It closed near the top of its range. Why would you cancel that? The reason why I would cancel it is because when support is broken, it affects the amount of risk in the trade. So if I wanted to keep my stop loss below the low of the day or below the recent lows, even if it rallied off of this, I would need to keep my stop down here, nearly 6%. So my risk has doubled on this trade. Risk is a factor for trade selection, at least it is for me. So in this case, this went from being an A-level trade where I was risking only about 3% to being, like maybe it's a B-level trade if I need to risk 6%. So I just canceled the order, and that was that. I hope that answers your question. These are the types of concepts that I was covering inside our brand new multi-time frame analysis course. I tweeted about it the other day. I'll post it again on Twitter and on Instagram, and I'll post about it this weekend too. Special sale on that course is going out, so stay tuned. Another question that came in: when you got to the level of consistency, how much of your average percentage profit years? So my average gain per trade right now is about 10%. Actually, it's been a little bit over 10% on the year so far. My average loss has been around 4 to 5%. So that's really where I like it to be. The reason why is because it gives me that 2 to 1 reward to risk, where if I flip a coin, there's a strong chance that or not even a strong chance, it's 50-50 shot that I'll come up with a winner. But there's if I keep on playing that game, it's I will come out ahead. And the reason why is because I'm getting paid $2 every time and I'm losing $1 each time. Right? That's looking at it at the broader scope. That's not the true reality of it though. That's looking at it at that 10,000-foot view. The reality is that some trades aren't going to make 10%. Some trades might make 2%, some trades might make 3%, some trades might lose 1%, some trades might lose 4 or 5%. But there's also trades in there that are making 10%. There's some trades that are making 15%. There's some trades that are making 40 or 50%. Over all of it, it comes out to about an average gain of 10%, average loss of about 5%, and the win rate of about 50-50. What is the maximum position size per trade for me? For me, the max is 25% of capital, and it's very, very rare that I get to that level. The last time I believe I was at that level was back in 2020. I need conditions to be optimal for me to get to that max amount of capital allocation. Right now, I'm in cash. I break down my position sizing into three basic zones: green, yellow, and red, just like a traffic light. Think of it like this: a traffic light in here, or when you see red, it, you might not be at a dead stop if you might see it from further away and you're rolling towards it and you're progressively slowing down. Eventually, the light's going to turn green and then yellow, and you'll be able to go a bit faster. For my trading, if I'm seeing an environment where maybe there's one quality setup, the market itself is choppy, most other trades aren't making progress, much like the environment right now, that will be a red environment for me. And in that case, I will be scaled way down. I'm only going to put on size of about 6.5% of capital allocation. And I'm only going to risk a maximum of 0.5% of capital. Oftentimes, though, I'm risking far less. And the reason why I'm able to risk far less is because the distance between my entry price and my stop is much, much tighter. How do I get such a tight entry and stop? Multi-time frame analysis. That's why I made that course, and I think that it's going to give people a great leg up. So again, I'll link to it. I'll link to it in YouTube, and I'll post it on Twitter and all the other platforms. Let's see, what other questions do we have here? What do you think about the companies that give 5% minimum monthly interest on $3,000? What do I think about the companies that give 5% minimum monthly interest on $3,000? Do you have examples, or are you talking about your employer. So if you have an employer and they're going to, there's many employers that will give you a, a base plus match, right? So they'll give you a certain amount to your retirement, and then if you contribute to it, they will match it up to a certain percent. If that's what you're talking about, then I would max it out. I would max out whatever the match component is going to be. If it's 5%, that's amazing. When I was working full time, it was a base amount plus 3%. So I would do more than that, but I would at least want to get that minimum amount that they were going to give. Definitely want to take advantage of that. That's like free money. Just scrolling through Instagram here, looking for the questions. You guys on the other platforms, YouTube, LinkedIn, Facebook, Twitter, get your questions in as well. Here's another thing too, for those of you that have been with us for most of this, I'm curious to hear what your big takeaways were from this conversation. So if you're listening, or maybe you're somebody that is watching the recording later on Spotify, I also take these recordings and I post them on Spotify. Take notes, post them on the social media platform of your choice, and tag me because I want to see what your big takeaways are. And if it's a really great takeaway, then expect me to repost it on whatever platform that you tag me on. Okay, here's a question. How did you interpret the 10-year bond mark that? How did you interpret the 10-year bond with the stock market? Okay, so one thing that I have been tracking is loosely tracking is the 20-year bond. So we'll take a look at the 20-year bond. The reason why I would track the 20-year bond is because the mortgage rate is fairly related to this here, right? So let's zoom in a bit. You could take a look at the weekly chart, and I'll get it up over here on the other platforms. So this is the 20-year bond, and you could see how it topped out way back here in March of 2020, came down, bounced a little bit in 21, and then it's been in free fall since. This is what is known as a stage four downtrend. Stage four downtrend. What's a stage four downtrend? A stage four downtrend is when price is below the 10-week line, it's below the 40-week line. Both lines are curved down. And you could see back here that it was attempting to come out of that stage four decline. It was attempting to get back into stage one. Stage one is where it's in a basing period. But often the case, what can happen is that you can roll right back over. From a much longer term perspective, perhaps it catches support somewhere in this vicinity here. Maybe it does, maybe it doesn't. Uh, don't know, but for right now, that it's still in a very steady downtrend. And again, the reason why I think that it's worth tracking has everything to do with interest rates. You might notice two lines on this chart here. This red line down here and this yellow line up here. They were Those two lines are highlighting what I was viewing as significant support and resistance levels. What you don't know is that I use this data to do a refinance on my house. And I thought that I had locked in rates back here in December, right? Back here in December. Yeah, you guys on Instagram couldn't quite see that. Thought that I locked in rates back there. Unfortunately, I didn't. And I didn't find out until about uh, February, right in here. February, March, right in there. And then quickly called the mortgage broker, told them to lock it in, and then it was locked in right there. Back then, the rate was about 4%. I don't know exactly what rates are now, but I would imagine, given this kind of drop, they are a lot higher. Last I heard when I was following it was somewhere in the 7.5%, which is super high, super high, but I wouldn't expect them to come back up anytime soon, really, or to drop off, I should say, anytime soon. See, it's now after 12 o'clock, so we'll need to wrap things up. I want to say thank you guys for coming in today. I appreciate it. I'd also like to hear what future topics you would like. I'm glad to pick out the topics that I think are the most important, but I also want to hear your thoughts if you have something specific that you'd like to discuss or to have an entire show around. Let me know. Post into the comments. Uh, Tag me on social media. That's a good way to get my attention. And I will see you guys next week. Take care. Much love. Peace out, everybody.